What's up, guys? Today we're going to talk about options and features on the farm. And we're going to dive into how we can understand how these tools can be used on your farm. So let's jump right into it. So first of all, the difference between options and futures. So we'll start with futures, which are standardized exchange-traded contracts, specific terms to buy or sell depending on the contract. And you guys have all seen these at your local elevator. It's what your cash price is based off of. It's influenced by global supply and demand factors, traded on an exchange. Options are financial instruments that are based on the value of the underlying. The underlying in this case for commodity options are these futures. So the option price is actually based on the futures contracts. These options have specific expiration dates, including strike prices and a premium to purchase them. We'll dive a bit more into options later. What I do want to mention, though, is that options do derive their value from something else. And in this case of commodity options, they're deriving their value from the underlying. The underlying in this case being a futures contract. So why do farmers use futures to hedge versus options? One difference or similarities, you can lock in your prices early with futures. So oftentimes with futures, there's more liquidity in the market. Liquidity means there's lots of buyers and sellers in the markets. You can easily transact. So you can lock in your prices early. So it's best for farmers who want certainty by securing a price early in the season. You can also protect yourself without selling your physical grain. So using futures, you can protect your price. If it's above your cost of production, you can lock in a price and protect yourself from these sudden price drops. It also gives you peace of mind. Knowing that when prices fall, you're protected. It can help you sleep better at night and just relax a bit, knowing that you've locked in some profit already. So what does it cost to enter a futures position? Each futures position has an initial margin requirement and a maintenance margin requirement. So very much like the name, an initial margin requirement is your initial amount of dollars you must have in your account in order to enter the position. A maintenance margin requirement is the minimum amount that must be maintained in your account at a given time. So when futures fluctuate, your account will go up and down in price. If your account value goes below your maintenance margin requirement, you'll have to input more money in order to bring it back up. So in this example below, you can see I went and pulled the initial margin requirements for soybean futures today. It's about $2,090. So that's how much you would need in your account to enter into a position on the soybean futures for March of 2025. And then the maintenance margin today is on January 2nd, 2025 for soybean futures is $1,900. So if you had a position in the futures and your actual value of your account and your maintenance amount was less than $1,900, you would have to input some money to bring that back up. So why do farmers use options to hedge instead of futures? Well, you have a defined maximum loss, and this means the maximum amount you can lose is your investment, while being able to protect yourself or participate in the upside. So that's really the biggest advantage of options, is when you're buying or selling, when you're buying options, specifically puts and calls, the maximum amount you can lose is your initial investment. The other big reasons are you can protect yourself, protect your downside very easily with defined strike prices, very visible, easy to see, and they're flexible, where you can create lots of different scenarios depending on exactly what you want to do and how you want to structure your risk and reward. So we'll jump into some of the more particulars or components of options, so we can really make sure you understand them before you dive into your first trade. So the three main components of options when you're looking at them are strike price, expiration date, and option premium. Now these all sound complex, but it's really not too bad once you start to get the hang of it. So the strike price is the price at which the option is in the money, and you can exercise the option, which we'll talk about in another in another module, but it's typically the price that you are protected below. And it's part of a standard option contract is you'll have a strike price. The expiration date. This is the date at which an option expires. So an option has a specific date where it's no longer, where you have to make a decision, or it's either in the money or out of the money. And I'll explain what that means by in the money and out of the money at a later point. Option premium. This is the cost of the option. This is how much it costs to actually purchase or sell the option. All right, so let's look at an example here on the SimpleHedge web portal. So you can see clearly here we have puts, we have calls, different types of options, and this is the futures expiration month. So as I mentioned earlier, all options are based on the underlying. So in this example, soybean March futures are the underlying. And you can see that the soybean March futures are currently trading at 1010.75 when I pulled this screenshot. And here's an example of a put. So this $10 is the strike price. This is the price at which the option is in the money. And you'll typically see it quoted like this. And on SimpleHedge, we make it really easy for you to understand. This is the $10 put for February 2025, which is the expiration date, February 2025. And then the 20 cents per bushel, that's the option premium. That's the cost of the option, how much it costs to purchase or sell. So you can see it's really easy to lay out. These are all the different types of, all the different components. And when you use a platform like SimpleHedge, you can see we've laid it out really easily for you guys to be able to understand and get started. So we'll go into the different types. So puts versus calls. So puts for farmers. Puts give you the right to sell at a set price if prices go down. And that set price is the strike price that I mentioned before. So if you expect lower corn prices or you just want to protect yourself, you buy a put as a farmer to lock in a good price. That way, if prices rise, your option expires, you lose a little bit of money on the option, but you sell your physical grain for a higher price because the prices have gone up. You're happy. You lose a little bit on the premium, but you make more in general because you're selling it for a higher amount. Your only loss is a small premium versus the upside of guaranteeing a profit. So if prices fall and you own a put, that put makes you money and locks in that price. So therefore, you're hedging yourself is what you're doing. You're making money either way, if the prices go up or if the prices go down. Now calls for farmers give you the right to buy at a set price if the price goes up. So fertilizer prices might rise. You could buy a call to lock in today's price. That way, if prices drop, you can skip the option and buy cheaper later. But if the price of your inputs go up, at least you're protected that way. Another way to use calls are you can actually sell your physical and get back into the market on paper. It's called paper replacement. So that way, if the price of futures goes up and you've already sold your grain, you can still make a little bit of extra money if your bias is bullish. Typically, calls are used as a more bullish strategy, or always used as a more bullish strategy if you're buying them. They aren't as, I would say, as commonly used as puts, because as we discussed in an earlier module, farms are inherently long. So typically you want to use puts to offset some of that risk instead of buying calls where you're adding to that risk. But there are scenarios where you can use either of them. So here's an easy way that I always learned, and an easy way to remember the difference between puts and calls when you're first learning them. Put down, you make money when the price goes down. Call up, you make money when the price goes up. So put down, call up, that's an easy way for you guys to remember the differences between puts and calls. So puts, you buy puts and the price goes down, you make money. You buy calls and the price goes up, you make money. Put down, call up. Easy for you guys to remember. That's it. I know it was a bit of a longer module, but that's how you can use puts and calls on your farm. A quick overview of some of the main ideas behind it. Yeah, we'll talk to you guys soon.